Hey everybody, it's Michael Martin. How you doing? Sorry I'm a little late this week with the recording. I had some travel, and then yesterday I had tickets to go to a ball game. I got roasted in the sun and watched the Dodgers lose. Had 10 hits and 12 walks, and they left 16 men on base or something like that. Hard to win ball games when you don't do well. So today I want to talk about, while I was at the game, I was talking with a friend about trading, and he asked me, like, well, what were the most important lessons you learned when you were starting out? Usually they're around losing money, right? Because you're like, oh, I'm not doing that again. I had a lot of that. I wrote about it in, the Inner Voice, all Inner Voice trading, everything that I did wrong, and I thought it was right at the time. Unbelievable. So anyway, I was thinking about patience, right? One of the things that I had to learn was to have an extraordinary sense of patience. And without rehashing, the whole I was born in a house my father built kind of story, it's the late 80s. Commissions are very expensive. There's no internet. There's no real community. There's not really even really good financial TV. But inside my firm, there was a lot of financial reports. What I learned the hard way was that these were compliance-approved reports that were meant for you to use to pitch your clients so that you could gather assets or generate commissions. I was like, well, that doesn't really help me, because how am I supposed to sift through all this stuff and figure where I should have the greatest sense of urgency? Where can I actually put these trades to work, and make money? And so, man, that was a painful lesson. But the main takeaway was, first of all, when you don't have a strategy and you see things moving, everything looks good. Oh, it's just like an advertisement where you see the happy people with the food. Like, wow, they look so happy. Maybe I should buy this. At the end of the day, learning how to read charts effectively and say, okay, this looks like it's setting up, but it's not quite there yet. We're still a week or two from this thing being kind of ripe on the vine, ready to go. And you learn the hard way of not being patient. What happens? You jump the gun. You see something's come down in a downtrend, or stage 4 in Stan Weinstein language, or what Victor Sperandio calls the one of his 1, 2, 3 reversal strategy. And you're like, man, I'm not doing that again. I've jumped the gun, and now I'm stuck in this trading range. I'm not making money. I'm not losing money, but cash has time value. That's Finance 101. And the thing's not moving, and now I'm in this trading range. So being that I myself am a visual learner, I went through some charts to show you where you might exercise patience, and if you didn't, what would happen. Usually, again, I lost money when I tried to jump the gun, so I had to learn how to not only read the chart, but then, like, what's the attendant order that would go with that type of chart pattern? Now, today, with technology, you can also set alerts first. So then you're alerted to, like, hey, the price is kind of in the neighborhood. Once that happens, you can go ahead and put your resting buy stop in above the market. If you're newer to trading, stop orders are really brilliant because they're suspended orders. You put them in, buy stops above the market, sell stops below the market, and they just sit there. And you're like, well, I don't understand how come it's not getting executed if I put the order in below. Well, they only get elected when the trade goes at or through your stop price. Then they become market orders. I don't worry about the limit part because that's a different order, a stop limit. And usually, for at least now with the type of size we're trading, if it's time to move inventory, I don't care about the price. I want to get out. I'm not going to get fussy about 2 or 3 cents of slippage and skid. You're overthinking things. Anyway, let me share with you. I will share with you my screen. And where is it? Yeah, here we go. Yeah, now you should all see that. First one is sugar. And this is when I was first starting out. I would find a way to get into this thinking like, oh, the bottom's already in. Here it is. And now we're going here. I'm going to be clever and get in cheaper because it's better to get in here at $16.49 than to pay $17. Boy, was I ever so wrong. Why? Well, look what happens over here, right? You have a little bit of it's not exactly sideways consolidation, but then it sells off, right? You have bases all over the place here. So we don't know, looking at it, that this can't continue to sell off to $15.50 at this point. It's a little bit too early. When I was younger, I would jump the gun here and think like I can really catch the turn. And then at $17.50 everyone else has to pay me. In most of these circumstances, by jumping the gun, it cost me money. Also, because my account was, I would say, underfunded, I had the equivalent of about 13K. It was, 5K back in the late 80s and is, about 13,000 in today's dollars, adjusting for inflation. So I didn't have a lot to spread around. I couldn't be as diversified as I wanted, so I had to be highly selective, but at the same time, I had to be very, very patient. Now, here's a better example of what happens when you jump the gun. This was Friday's trading. You can see the market in gold. It took out these near-term highs, certainly challenged these highs, but then came back and basically settled flat, right? It opened at 87.9 and settled at 91.3. So really, to me, I look at it, it opened and closed basically, flat. Yes, it was up on the day, but that to me is a reversal pattern. And so I would have been trimming my positions coming into the close, even though I wouldn't consider myself a day trader, because it failed, right? Everything above here was a green bar, and that came all the way back. So there's virtually no green except for maybe $3 from the previous day. Now you sidestep, at 100 troy ounces, this is a, $8,000 move. So sometimes it's going to happen. You're going to get in, you're going to get trapped, you're going to get knocked around. Nothing ever works in a foolproof manner. But what you would have looked for is confirmation, and look for the close and have it stick. The minute it starts coming back, depending on where your entry was, you would have had to have put in a protective stop to protect your cash, at least at break even. Let's look at coffee. Coffee's a little better chart. Again, I'm not telling you to go trade commodities. You'd have to talk to a financial advisor to know if that's appropriate for you or not. I'm using these charts to show you examples of what two traders would refer to as some type of trend reversal. Stan Weinstein's book and Victor's book, Methods of a Wall Street Master. Victor would call this a 1, 2, 3 reversal. Stan would call this a stage 4. Then the sideways part would be stage 1. And then look, when it starts to break out to the upside, that's the beginning of what Victor would call 1, 2, 3, would be the upward movement here. And Stan would kind of refer to this, I believe, as the beginning of a stage 2. Now, it's very, very early, right? But that's why, yes, in this case, if you jumped the gun, you got away with it. If you tried this, normally with sugar back here, you don't know. So in this case, it worked out for you, but one example doesn't make it a theory, right? We always say that gold isn't a religion, it's a trade, to quote my good buddy J.C. Peretz recently. So how do you do this? Well, you could set an alert for, say, 300 and then have that pop up. Or if you're looking even tighter, you can kind of cheat, call it 295 for the alert, then know, okay, well, where's your buy stop going to be? I'll put a resting buy stop at 300, or if you want it to clear these highs, you could put it a little higher. Maybe that's where you even want to add. It's really up to you. The point being is that now you know for sure that the buyers are in control, at least in the short term, of the underlying instrument. We can go back to look at cocoa, same exact thing. Big sell-off, super choppy. Now, cocoa's unique in that they doesn't have any daily limits, so this thing can haul. When you see this, it's $10 a tick, so this is $4,600 in a day. You've got to be super careful because, it opens early, opens 8 o'clock Eastern, 5 o'clock California time. Again, no daily limit moves. You got to figure out whether this is appropriate for you or not. My job here is to show you what these reversals look like and how you get paid to be patient, right? That's the whole ethos of today's chat. So same type of a thing. It starts to break out. What's the number that's material for you? I don't know. Maybe you want it to clear here or clear here even. I don't know. But after this V bottom, which are difficult to trade, you can see that there was resistance around 7,800. You could set your alerts, set your stops accordingly. Again, this contract can really haul, so you have to be super mindful. Even today, look at the high was 88.23, right? And it came back almost 100 points, was at 91 points almost, or something like that, from the high. So that's a big move at $10 a tick. You can see open interest though is going up and the volumes are going up. tells you that new longs are entering the market. Now, this doesn't just happen with futures, it happens with stocks too. I'm not advocating that you go out and you start buying, penny stocks. It's not my thing, but I'm using the chart as an example. So again, big sell-off, stage 4, stage 1, right? This one's unique in that, look at this day. This whole thing was green and it virtually came all the way back. This is what happens with short squeezes. You have good news hits the tape. People buy in even though there are options on this. They pile in and then they pile out. You could look at the volume was more than 2x on the day on the average volume. Same thing, probably good news. It was green. Then it comes all the way back and then it's flat and looks like an upside down capital T. Then it starts to sell off and now you're in the red. And you have 10.5 million shares against an average of 1.5. So again, who knows how these things trade? I try to stay away from them myself. But then if you wait or you keep at the strategy knowing to keep your losses small, eventually the thing takes off. And, having some type of a buy and hold or options trade strategy, the stock traded up to 6 after breaking out of like 330. Before now it's super volatile. Who knows where? Maybe it continues up or not. But this is an example of like a 1, 2, 3. Here's the 1 primary trend. The 2 is the consolidation. The 3 part is the upward trend in the opposite direction. Stan Weinstein calls this stage 4, stage 1, stage 2. Now this could be a super messy $1 or 20% trading range or base, if you will, in the stage 2. Maybe it takes out 6. I don't know. Maybe it takes out 550. Again, this is why you can use, your alerts, right? And you can set yourself up to win by not jumping the gun. Force yourself to be patient, using alerts as like a speed bump in your trading, not jumping the gun, trading small at the beginning, making sure that you're not putting on too much. I think I've heard even Jim Cramer say that if you put all your entire position on all at once, it's kind of an ego trade. You're saying this is the spot. Now, if you're scalping, that's a different ball of wax. This is more about making bigger money than scalp trades for 20, 30 cents. Certainly you could do it. But, if you took that first trade on B. Riley and you sold at the end of the day, you made 60 cents. It moved another $2 after that, or more than 3 times. So you left the majority of the money on the table at that point. But if I go back in time and stick to the thesis, the biggest thing I had to learn was, because I had ample cash to trade, but I was still underfunded. Commissions were expensive. I had to be highly selective, and learning to actually be patient, which is not anything that I would intuit would actually help me, was really, really important. Because again, without having a defined strategy at the time that I could call my own, right? Because I was kind of formulating my trader identity. Who am I in the market? What kind of trader am I? What asset classes do I trade? What's my holding period? All that kind of comes through trial and error, experimentation. There wasn't lots of opportunities to do paper trading or otherwise. There was no online community. There was no online. There wasn't mobile technology either. So you're really out there by myself. Today, you might look at that and say, you're an idiot. But at the point is that the resources that we have today just weren't there. Now it seems a little bit easier. So I've tried to, use today's vernacular by using, most platforms have some type of an alert deal, whether you get pinged by the app and you get, in-app notifications, or they might even send you a text message or an email or something like that. Use those alerts to your advantage and set them, not so close that, the thing blows through your alert, but then it also can blow through your intended buy stop price too. So you end up missing things. So you have to kind of think of it like as the first opening move of a chess match where you're moving your pawn and getting things going that way. It's an important lesson. It wasn't one that happened overnight, but even for those of you that are scalping or day trading, it doesn't mean that you have to be in the market every day, right? It doesn't mean that at all. So you can still elect to be patient and then wait for your setups, put them on, do what you have to do, go about it that way. But that's where I try to help and have some very relatable, frank discussions about where what were my growing pains, what were the things that I had to learn to thicken my skin. which, let's face it, this is something that everybody has to do. It doesn't matter what your age is, how long you've been trading. If you jump the gun and you don't wait for the criteria, I think I've mentioned it before in another episode along the lines of like, you're trying to get away for a 3-day weekend and you're going out on the road with a quarter tank of gas. You're not prepared. So by using patience, you have to, it typically works in your favor. You definitely have to be mindful of the ready, aim, 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 aim thing. Like sooner or later, you have to shit or get off the pot and pull the trigger. But not jumping the gun and waiting for confirmations can really, really improve your win-loss ratio and then thus the expected value of a trade. If you'd like a free copy of the audiobook version of The Inner Voice of Trading, you got the link in the description. Please like and subscribe. There's also a link if you want to suggest an episode for the show here, or if you want to inquire about the education. Have a great week, folks.